Welcome back, Novello Nation, to another episode of the Aaron Novello podcast. We have with us some awesome human beings, absolute rock stars in the lending game here locally where we do business. They're our lender of choice. They are branch partners, brothers, also responsible for 370 plus mortgages a year, $125 million of money lent. The one and only dynamic duo, Mr. Danny and Ari Tokar. Really appreciate you guys taking the time to be with me here today.
Thanks, Aaron. Appreciate you having us.
Yeah, my pleasure. So, I think that this is on people's minds right now, and that's why I wanted to have us on and having this conversation together because, the game has changed pretty quickly. And we've seen interest rates kind of rise dramatically in a very short period of time. So perhaps before we get to that piece, talk to us a little bit about your guys' evolution, like how you came to mortgages and how you came to, being branch partners with your current, organization, Benchmark Mortgage.
Sure. So, I'll start. And again, thanks again for having us on. So when I started in the mortgage world, it was 2013. I was in the process of buying my home at that time. And some things that happened at the end of the process, I was buying a condo, some things that happened at the end of the process that caught me by surprise. And at the time, my loan officer, I had inquired it within, about potentially coming into the business and learning how to do mortgages and kind of teach people the way and kind of take the surprise element out of the end of the process. So I came in the business in 2013. I worked as a production partner under my mentor for close to 7 or 8 years. During that time, for the first year I was a production partner. I set up all of their loans and another loan officer's loans, took, and learned the business really intricately, took files from start to finish and really just, worked on the qualification end of things. I started to grow my team. Ari, I believe, was my second or third hire. I really needed someone that I've known for a long time and I can trust, intricately to be able to help, take us to that next level. And we quickly, grew our volume from 70 million, then 100 plus, year on. So the third year in of us originating, we were doing about 100 million in volume at that point. It wasn't until about two years ago, a little bit over 2 years ago, right before COVID started, that we had an opportunity with Benchmark to really grow their local market. They've been around for almost 30 years at that point, not been in the Florida market. We had a couple mutual connections within the organization that we were able to connect with and really sit down and just, kind of hear what they were about and how they operated.
We've been, our focus has been equally on continuing to grow and refine our own production and how we serve our partners, but also to be able to bring some other people into the business. And there's not a lot of people out there in the mortgage space that will take a chance on someone without experience. It's something that, Danny and I both recognize that we both got an opportunity in this business at some point because someone took a chance on us without that experience. And, we really we want to pay that forward. So it hasn't, we've had the opportunity to bring some people on and really kind of coach them and mentor them and bring them through our system, hopefully have them learn from our experiences and not necessarily, go through all the pain that we went through at times and trying to figure it out, because we figured some stuff out over the years. And like I said, hopefully, grow some production and some great partners and outside of just Danny and I.
Talk a little bit about the environment in the marketplace and with interest rates when you first got started. So what was happening at that slice in time in the market?
Yeah. So when my first few loans that I originated, rates were right around 4.7, 4.8. Quickly fell after that. I had a long period of rates being somewhere hovering around, in a best case scenario, 2.6 and, to about 3.25, 3.3 for a very long period of time. Right before COVID, rates started to creep back up. They had hit that high 4s, low 5s range, and everybody in the world was saying, okay, here it is. This is way overdue. Rates are going to start going back up. And the days of low rates are gone. And then obviously COVID happened, the world shut down, life changed, domestically and internationally, basically overnight. Things kind of just came to a screeching halt for a while. Not that long of a while, but long enough for it to be concerning. there were some shifts in the financial market that caused our government to step in and basically, for lack of better words, write a blank check for mortgage-backed securities. Which really drove rates down, drove it down fast, and created an extraordinarily volatile environment for quite a while. But ultimately, the end game was rates fell, and they fell to a point where they had hit the lowest level in history. They stayed low for quite a while. The Fed kept purchasing unlimited amounts of bonds for a long, long time.
Why is it that when mortgage-backed securities are purchased, that rates at basically an unlimited quantity, that'll keep rates low?
The easy answer for that is that you basically have an unlimited buyer of your product. So you're creating a situation where if the government's not just buying everything, then you have a private market for these bonds, and people compete. They're going to compete for the cost of the bonds, but the government's just out there just saying we're going to keep buying them, buying them, buying them, buying them, buying them. So a lot of the private market went away or scaled back, and the government just literally stroked the blank check, which ultimately drove the value of these bonds down. But what happens is, when the government comes out and says, hey, we're not going to continue to purchase these or purchase these at the levels that we have been, all of a sudden you're waiting on private money to come back in and regulate that market and find where the value, or not the value, but where the cost that they're willing to pay for that coupon is.
Well, so what started as the government taking action because they needed to provide liquidity to the market, because had they not stepped in and said, yes, we're going to purchase mortgage-backed securities, there would literally be no market for mortgage-backed securities, which means no matter what happens, unless a bank was lending their own money, portfolio lending, like mortgages would have stopped. So the Fed came in and provided liquidity to the market. The Fed also kept, as Danny described, almost unlimited liquidity in the market for nearly 2 years now. Rates were kept at an artificially low level for such a long time that the only way out was kind of the let's rip the Band-Aid off approach. And what happened was the Fed announced not only that, and this doesn't take into account any of the other external factors like wars or anything like that contributed, right? But the Fed basically said, we're going to stop buying. We're going to taper our buying of mortgage-backed securities, which is going to, in theory, bring the private market more into play, which the private market is going to have a higher expectation of returns, which means rates are going to be higher because the return on that investment has to be higher. And that happened in conjunction with major supply chain slowdowns, war in Europe, all these things, inflation that all of a sudden hit 6, 7, 8% month after month after month. And that's where we're at right now.
Because my hallucination is you had a bunch of buyers that were pre-approved 60 days ago, and then we look at their pre-approvals and they're like, hey, Ari, sorry, brother, you are no longer approved for that amount. We got to look for homes that are $100,000 less. So talk a little bit about like that and how that's like shaking out.
Yeah, so there's definitely the increase over the last 6 months has definitely, even the last 2 months has definitely lowered people's qualifications in combination with increasing the cost at the value. Like if it doesn't affect their qualification, if they're well qualified and they still want to buy that same house, it is now more expensive. One thing that's super important is that making sure that, as a realtor or a client, you're always out there staying in touch with your lender and whoever's helping you buy a property, and make sure you have up-to-date information. Make sure that you know what the market is right now, so that way there's no surprises for you. The banks are not increasing the guidelines for what they allow people to qualify for. So you are seeing people that are at the brink, if they're at the highest debt to income ratio that they're allowed to be at, that it might push them over, which then would require them to lower their purchase price, maybe pivot from looking at a condo that has an HOA with, a higher HOA to something that's more of a townhouse or a single family without an HOA, keeping in mind the insurance and tax variables.
Yeah. So in preparation for our call today, I said, let's look at a typical loan amount, a $500,000 mortgage, right? Which in South Florida is not an unreasonable mortgage amount, right? And so going from looking over the last, say go back 6 months, and let's just say we're looking at a rate of 3.5 versus 5.5. Well, if you're talking about dollars and cents for a borrower, it's a difference of almost $600 per month in just principal and interest. So there's a tangible element to that. You take a principal and interest payment that goes from 22.45 to 28.39 with the 2% increase in interest rate, right? Then to what Danny was saying too, well, part of what we do as our process is it's not just what do you qualify for, but there's a lot more questions that go into it. And what can you afford is one of the most important ones there. There's a big difference between, for some people, what can you afford and what can you qualify for? And under normal markets, if you have a client that says, well, my comfort level, I can afford $2,500 a month. And we say, okay, well, perfect. You can qualify for $3,500 a month. So you're in great shape because you're going to be able to purchase something that you can afford, and it's well within the parameters of what you qualify for. In the market over the last couple of years, there have been times where some clients that relationship is a little bit, inverse. Someone might want $2,500 per month, but they might only qualify for $2,200. And then it's like, okay, well, what changes? Because there's only a couple of things that can change. It's either change your search parameters, find more income, which could mean a co-borrower, could mean a couple different things, get rid of some debt. There's different ways that you can, help someone qualify for more. But again, that balance between afford and qualify are kind of important. So if you're talking about a borrower that is, let's just say, very well qualified and isn't going to have an issue qualifying for the payment, it is then just a question of it's going to cost you more for that same house at the same interest rate, right? On the flip side, if you're talking about the borrower, what Danny alluded to, someone that's pretty close to maxed out on their qualification, right? They might have been in a $400,000 or $500,000 price range, and all of a sudden, their maximum might be $300,000 to $400,000.
Really being upfront with expectations, not only on your end, as far as what the money's going to look like and payments and all that other stuff, but also on our end, as agents, educating them on, okay, here's realistically what you can expect. So that way there's no surprises kind of moving forward. Now, what I'm also taking from this conversation is for those people out there that are thinking about selling, what I'm aware of is that there's two emotions that dominate any market. One is greed and the other one's fear. And what I've personally seen in the marketplace is that first one come roaring and raging, right, over the last 12 months. And I think consumers, it takes them a while. Last time, because I was selling real estate in 2008 and 9, and it took about 12 months for sellers to recognize like, oh, this is like a different environment. And what I'm aware of is like that affordable price point. I'm not seeing it there as much, but I am seeing it in the higher ones where you're not getting 10 or 12 offers, you're getting 1 or 2. And you're not seeing as aggressive terms and conditions. So the other thing I'm kind of sensing from you guys, that if people have been sitting on the fence like, oh, I'm going to wait and see what happens, that if they want to sell, they should probably do that. Is that right?
Listen, as long as they've got a plan, right? And that's the key. And that's what goes in. Yeah, because they are sitting on a ton of equity. And if they've bought any time within, really since 2000 and what, 10, they're sitting on a huge, huge stack of equity that they can then turn around and leverage into one of many things. Whether that's a primary with an investment or a second home attached to that, not physically attached, but, in general, or just be able to help change their financial outlook. Listen, I'm a big believer. It's always a good time to buy or sell. When you're renting, you're paying 100% interest rate. You're paying somebody else's mortgage. So if, you've got someone sitting on a high equity position, there's a lot of different things that they can do with that.
And I think, Aaron, you were talking about the affordable range, right? Which, we know that range always moves. But, Danny and I, one of the things that we kind of getting back to like our passion for helping people, right? And we've always kind of felt that like our core of our business is going to be working with the clients and working in the price range for the homes that people need, not necessarily the homes that people want. Because if someone has a house that serves their family, they just want something a little bigger and nicer, it becomes a little bit more, it's more disposable income, right? So that's where you start to see it soften first. I think that's where we're seeing it a little bit. But even still, a listing in that luxury or a high-end price range that's getting even 1 or 2 offers on the first weekend, typically at or near full price, is still a pretty strong market, right? So it's just not what it necessarily was 6 months ago or 12 months ago.
Yeah, 100%. And I'm in agreement with that. I think over the last 2 years, people just got spoiled with a certain environment in which they could buy whatever they wanted and sell for whatever they want. And now we just have a reality coming back into the
Just gonna have an
market.
adjustment period.
Just an
So
adjustment period.
I
Hey,
think
that
if
was a
someone was gonna
very
sell their house-
politically correct way. Danny said, we have an adjustment period, ladies and gentlemen. So listen, guys, this has been really educational. I think people are going to get a lot of value from it. I appreciate, again, you taking the time. So if people want to find you, if they want to ask you questions, if they want to talk to you about mortgages, things of that nature, where can they find you? What's the best place for them to get in contact with you?
My phone number is for anybody that has any questions, whether it's relating to buying, selling, refinancing, or just have some regular mortgage related questions that they want to go over, financial related questions. My number is 954-589-3661. That's my direct line. Ari, you want to go ahead and give your contact information out?
Yeah, sure. Mine's 561-714-4218. And geographically, although, we kind of described at the beginning, we work together. We have everything. Danny's in Broward County. I'm in Palm Beach County. We have offices in both places. We like the opportunity to meet face to face more than we did over the last couple of years too. It's nice to actually get to talk to people. So yeah, our Ari.Tokar at benchmark.us, Danny.Tokar at benchmark.us, or give us a call on our cell, and we are both happy to help.
Perfect. And those are the kind of guys they are. You get their direct cell phones. That's not the case with, when you're dealing with the partners in the organization. And I can attest to the fact that they'll pick up the phone whenever I call them. They pick up the phone immediately. So if you guys have enjoyed this episode of the podcast, be sure to smash the subscribe button. If you think somebody else could get value from it, just go ahead and share it. And we look forward to connecting on the next episode. I really appreciate you guys taking the time. Look forward to connecting soon. Okay.
Thanks, Aaron.
Thanks again for having us, Aaron.
My pleasure. What's up, team? We are here with the talented, very successful Mr. Lars.
Good looking.
Yeah, oh, that's true. Yeah. Good looking.
Humble.
Yeah, humble at the same time. Heddenborg. It's not a regular occurrence that I sit down with someone that actually punched me in the stomach.